Let's take a look at our first example. Watson Associates purchased $60,000 of equipment early this year, 2024. The company estimates the equipment to have a useful life of 3 years, and it uses straight lines, so we'll have $20,000 of depreciation expense in each of the 3 years. However, tax rules allow the company to take the entire $60,000 deduction in year 2024. There'll be no depreciation expense in the next 2 years. The company has a 25% tax rate, pre-tax accounting income of $100,000 in each year. What we want to do is get to the journal entries for income tax expense at the end of each of the 3 years. So let's set up this example. What we're trying to do is not just simply jump right into the journal entry for the income tax expense, but try to understand why the deferred tax liability is going to be what it will be and how it will change over the period. Okay, so we have from GAAP or book income. Let's take a look at income before taxes and depreciation. Straight line, $20,000 depreciation expense per year, $100,000 after depreciation. So before depreciation, we would have $120,000 of income before depreciation and taxes each year. This would be a total of $360,000. Depreciation expense, $20,000 each year. And then the difference here would be pre-tax income of $100,000 each year. What would we see on the tax return? The tax rules allow the company to take the entire $60,000 in year one and have no depreciation expense the following year. So we still have the same $60,000, the same. Instead of calling it pre-tax income, we're going to call this taxable income. Over the 3 years, it's the same, but we see this timing difference between pre-tax income and taxable income. So in this first year, 2024, assuming this is the current year, 2024, we see our pre-tax income is higher than our taxable income. But what we know is that our future taxes are going to be higher, and we want to give investors that information. We're going to do that by creating a deferred tax liability. So we take this taxable income, we multiply it by the tax rate. And we get income taxes payable that we would see on the tax form. So again, taxable income this period is lower than the pre-tax income, but we know that it's going to be higher in the future because our taxable income will be higher in the future periods. We can look at this as if we break it down just into year 2024, we have pre-tax income here of 100. We have a temporary difference that gets us down to our taxable income of 60. And that temporary difference is going to be a 40. And this 40 comes from the tax depreciation of 60 minus the book depreciation of 20. Taxable income of 60 times the tax rate, 0.25, gives us our income taxes payable of 15. So we have that before, but now what we want to do is look at these future amounts and the future temporary differences. So we have a temporary difference this period of 40, the difference between our depreciation expense here and our depreciation expense here. And then in the future, we're going to have a temporary difference of 20, and then another temporary difference of 20. So what we're saying here is future taxable income will be higher. Total of 40, and if we multiply that by the tax rate that we expect to be in effect at the time in the future, let's just say it's going to stay 25%, the taxes on the future amounts we expect to increase our income by leads us to estimate that we're going to have to pay $10 more of taxes in the future. This is our required ending balance in the deferred tax liability account. And so if we think of this as a T account, it's a liability, so we want to credit. We want to have this $10 in our deferred tax liability balance. Let's assume we start with a zero beginning balance. We need to record $10. We need to $10,000. Increase the deferred tax liability by $10,000. And so the journal entry at the end of 2024, we need to debit to increase income tax expense. But remember, that's our plug number. When we looked at the steps to calculate the income tax expense, it's the last thing. And it's based on what we're doing with our income taxes payable. And in this case, we're just going to have one deferred tax liability. So start with our income taxes payable. Straight from the tax form. Although we were able to calculate it here as 15,000. We know that we need to increase the deferred tax liability by 10. So credit to increase the liability. And then that difference, we're going to plug that difference into income tax expense. And that's our journal entry for 12/31/24. Now, if you're wondering, couldn't we have just simply taken our pre-tax income of 100 and multiplied it by the tax rate of 25% to get that 25? You're exactly right. The only reason that we use this plug here is that sometimes the tax rate will change, and sometimes we're going to have permanent differences. So we want to get into the habit early on with always making this income tax expense equal to the plug number of the rest of the entry, and that will always get our answer to be correct. All right, let's continue with this example. We did 12/31/24. Now let's think about what's going to happen the following year. In 2025, we have pre-tax income of 100. We have some temporary difference that gets us to our taxable income. Our taxable income 2025. Taxable income was 120. Pre-tax income was 100. Multiply this by the tax rate. This gives us our income taxes payable of 30. And let's think about the future now, just like we did before. It's 2025, so what do we know? In 2026, we're going to have another temporary difference of 20. This is our future taxable amount. And it's our total because the asset will be out of use by the end of 2026. So we can multiply this future taxable amount in total by 25%, and we get 5. This is our required ending balance in the deferred tax liability account. Okay, so let's go back to this T account that we have. Let's make another one for this period. We start 2025 with a $10 or $10,000 beginning balance, what we ended last period with, and we want 25% of the future taxable amount, which is 5. We want our ending balance to be 5. It's a liability, so we want it to have a credit balance. How do we get it there? It starts with 10. We want it to be down to 5. So we need to decrease or debit the deferred tax liability account by 5. So when we come to do our entry for our income tax provision, or income tax expense, debit income tax expense for some amount, we're going to use some plug number here. We're going to debit to decrease deferred tax liability. By 5. And we're going to credit to record the fact that we owe income taxes according to IRS code for 30. Plug in our income tax expense of 25. This is our journal entry at the end of the second year, 2025. Remember that income tax expense is reported on the income statement. Deferred tax liability, now this 5 is not going to be what's reported on the balance sheet. Well, not that 5, not the debit. This 5 is going to be reported on the balance sheet, a credit of 5 for deferred tax liability. And income taxes payable of 30 is going to be reported on the balance sheet. And if you're wondering what about the income taxes payable from the prior year, 15, let's assume that was paid during 2025, and this new amount comes on at the end of the year. Okay, in 2026, we have pre-tax income of 100. We have this temporary difference of 20 again. Come back up here, we see pre-tax income of 100. Taxable income of 120, so that difference of 20, that gives us our taxable income. Income taxes payable, 30. Okay, so what's our future amounts? Future taxable amount? Well, the asset is fully depreciated. So there's no future taxable amount. That's 0. We want our deferred tax liability balance to be 0 at the end of 2026 because we have no more asset. So our deferred tax liability account currently has a credit of 5. We want it to be 0. So we need to debit another 5. So when we come to do our income tax provision entry, debit to decrease the deferred tax liability an additional 5. And we're going to plug income tax expense to be 25 once more. Now, another way to look at this is from a balance sheet perspective. So same numbers, same example, but let's look at it from a balance sheet perspective. Meaning the book value of equipment. Well, let's just say the equipment, and we're going to look at book value, meaning from the balance sheet perspective in each of the 3 years. Okay, so we buy at the beginning of 2024 for 60 million, and then during the year we depreciate at 20. And so at year end it has a book value of 40, and then we take another 20, and then by the end it has a book value of 0. What we would call the book value on the tax form, we call that the tax basis. And we depreciate the entire asset in year 1, and so it has no value to it. Well, let's take that difference. This is our temporary difference. This is just another way to get to our temporary difference without looking at it from the income statement perspective, but from the balance sheet perspective. Multiply that by the tax rate. And this is the required ending balance in the deferred tax liability account. It's going to be 10. We have to remember this is a liability, so it needs to be a credit. 10 needs to in 2025, this needs to be a credit of 5 and then nothing. In order to get what is the amount that we need to put into our journal entry for our income tax provision, we need to look at what is the existing balance. And so when we start off, we have nothing else, then we have 0. And so we need to record 10 credit. When we start off with a credit of 10 and we want it to be a credit of 5, we need to debit 5. And when we have 5 in a debit and we want it to be, oh, sorry, we booked the debit of 5 and that left us with a credit of 5. We want it to be 0, has a credit of 5, we need to book another 5 debit. So just another way to look at the exact same information.